Let's be real, investing is hard. It can be quite difficult to figure out which asset you want to buy and when you want to buy them. Sometimes you end up making mistakes buying at tops. That can hurt quite a lot, but you know what hurts more? Selling your stocks at the wrong time. In this video, let's look at 10 terrible reasons to sell your stocks. Hopefully after watching this video, you can avoid some of these for the rest of your life. Let's begin. Before we get into the reasons, as usual, nothing in this video is financial advice and is made for informational purposes only. While we should all keep these reasons in mind, we should also remember that sometimes there are personal reasons why we have to sell our stocks, and we should do whatever suits our needs. And if you do make some mistakes, never be too hard on yourself. Just learn from the mistakes and continue investing. Anyway, let's get to reason number one of the most terrible ones, that is following mainstream media narratives. This one applies to buying, selling, and anything in investing. Never blindly follow mainstream media narratives. One of the main goals of mainstream media nowadays is to create clickbaity and sensationalized headlines. They'll call these expert predictions, and we can often fall for these traps. Especially during bad market times, you'll see a lot of fear-inducing market commentary. This is something we have to avoid. We have to focus on the fundamentals and keep investing even through bad times. If you just listen to the mainstream media, you'll feel like selling out of your stock at any given point. The only time they're absolutely bullish is during very frothy market times, as we saw during 2021. These are often the bad times to be buying stocks. The reality is that the only way mainstream media works nowadays is through short-term focused news cycles. If they didn't do this, they would not survive. Remember, media outlets profit from engagement, not from helping you make money. So please do not take their inputs while taking your selling decisions. By the way, I have this full video about how mainstream media can keep investors poor. Feel free to check it out. So now we have spoken about mainstream media. A close second one is influence because of social media. There's a lot of investment and financial advice on all social media platforms nowadays. The biggest example of this is Wall Street bets on Reddit. Social media can create a lot of hype, as we saw with GameStop and AMC, but it can also create a lot of panic during market downturns. Similar to mainstream media, social media influencers are also making money through engagement and not by giving you advice. They'll keep saying it's not financial advice, but they know a lot of people are taking their stock picks to heart. People end up investing in things, and when market downturns come, they don't know what to do, and then they look towards influencers again. And during market downturns, all the news is negative, and so are the social media influencers, because that's what's selling during that time. You should also remember that bears sound smart, but bulls are the ones who actually make money. The fact is that social media is there to amplify short-term noise rather than signal. Now, this is not to say that there are no good social media influencers out there in the finance space. There are a lot of good ones. Even I rely on a couple of them for good information. The point is that you need to find who these people are and then figure out if they are the good ones. This can only be done by following them for a long period of time and also testing their strategies all the time. Use them as a learning mechanism, not to blindly follow and take your decisions. Another very closely related one is actually following the crowd. You might have heard about FOMO buying, but there's also FOMO selling during market downturns. Everybody is rushing to sell, and everybody sees this and starts doing the same thing. You have to avoid doing this. Herd mentality is becoming a bigger and bigger problem when it comes to retail investing. Everybody is looking for some sort of reinforcement when it comes to investing as well, and they try to do the same thing all at once. But the reality is that the crowd is often wrong at major market turning points, and this has been proven time and again. In fact, if you follow the advice of somebody like Jason Shapiro, who's actually a very accomplished trader, he says that it's profitable to take the opposite bet of a crowded market. In fact, a majority of his thesis is actually based on this. So the mistakes we have seen so far have a lot to do with investing psychology rather than the fundamentals of the company or the price of a stock. So let's look at some of those as well. On that list, another wrong reason to sell your stock is because the stock price has risen too much. Yes, this one's the good old "it can't go higher" mentality, and this is something I'm guilty of quite often. I left out more than 100% profits on the table by selling my Nvidia stocks too early. I was very disappointed with myself. However, a lot of that money ended up going into Palantir, which has done quite well as well, so I'm not totally mad. But this is why it's very important to focus on the fundamentals and look at the forward projections rather than having arbitrary price targets. What you might be doing is actually missing out on compound growth. The reality is that if you invest in a great company, these can continue growing for decades, and in fact, these are the companies that you should be investing in the first place. We often don't know why we are selling out of a stock. For example, I wouldn't sell my Amazon or Google stock no matter how high it went, because I'm investing in them for decades to come. I don't know why I ended up selling my Nvidia stock. stock? It was probably because it was going up so quickly. That is the mistake we have been talking about here. I should have stuck to the fundamentals, looked at their forward projections, and even looked at their earnings a couple of quarters before deciding to sell. And that's the mistake I do not want to make again, and I do not want you to make it again. Another terrible reason why people are selling their stocks is because they're reacting to broker downgrades. There are countless brokers and analysts on Wall Street who are constantly shifting their opinions. They create these short-term price targets, and the retail investors try to play this game as well. You have to remind yourself that most of these people are not investing their own money, and in fact they're not even beating the S&P 500 in the market. They're making their money through fees. So following them may not be the right decision for you at any given time. You might come across a lot of conflicting analyst recommendations, and it might lead to analysis paralysis. Just look at this. Even Amazon, Google, and Apple have faced numerous downgrades during their massive growth. But over a long period of time, all these stocks have grown and made a lot of money for their investors. Playing this game of buying and selling is not for investing. If you want to play this game, create a separate trading portfolio and do it in that. Always try to create your investment thesis for at least 5 to 10 years. Unless something fundamentally changes, do not sell your stocks. Talking about this, there's another reason for selling your stocks, and that is you're looking at what the CEO and insiders are doing. Often in the news or in some tool, you might see that insiders are selling their stock. Yes, it can be scary because you start wondering, why are they selling it now? Is the price too high? Are they taking profits? Should I be taking profits? And this can lead you to you selling your stocks at the wrong time. You should not be overemphasizing on executive transactions. The reality is that you're ignoring the context of these sales. Executives often sell for personal reasons unrelated to company outlook. Of course, they try to find a good time to sell their stock, but it's not because it's always overvalued. Sometimes they just need the money because a lot of them are getting paid in stock only. Overall, I would say that while insider selling shouldn't be completely ignored, it needs context. Executives often sell shares for personal reasons like tax payments or portfolio diversification. It can definitely be a good indication in combination with a lot more information, so be careful of what you're looking at. The next reason you might be selling is because the stock declines after strong earnings. This one's a bit tricky because you might start wondering, why is the stock selling off after good earnings? Is there something you don't know? And this can lead to some fear and you might sell out of your stock. This actually often happens due to profit taking or short-term traders. But remember, company fundamentals typically drive long-term performance. Let's not spend a lot of time on this because this one's quite straightforward. If the stock price goes down after strong earnings, be careful. Just look at what's happening, look at their fundamentals, and then figure out what you want to do. Often you have to do nothing. In fact, you might want to buy when the dip comes. Also, I want to tell you one more thing. Even if earnings are a miss, that's not a reason to sell your stock. You have to look at what exactly did they miss, because sometimes mixed earnings can send different signals to the market. Now we are down to the last 3 reasons you should not be selling your stock. The first one on this is actually reacting to bad economic numbers. Now this one's all about macro factors, and you might think, how can I not react to macro? And that's true. Macroeconomics plays a big role in investing. You should be fully aware of what's going on in the macro environment to figure out what you want to do with your investments. However, what I'm saying is do not take abrupt decisions when it comes to these factors. When looking at things like GDP reports, inflation data, or employment numbers, you need to consider that the market is always forward-looking. Retail investors will never be at the forefront of these numbers. There's always somebody who knows this, and insiders are already playing the game. By the time you decide to sell, the market might have actually sold off already. Now you need to decide whether it's still the right time to sell. You also need to remind yourself that good companies thrive in various economic conditions. So if the market has already sold off, it might be a good time to actually buy those companies. This one is a very complex topic and needs a lot of time to actually study and understand how to react to these different numbers. But for the purpose of this video, all I'm saying is do not take abrupt decisions when it comes to macro factors. You need a lot of data to actually take these decisions over a long period of time. If you see there are fundamental shifts in the macro environment, then you might want to act on it. A good example of this is actually the bear market of 2022 and 2023. If you're somebody who sold in 2021, that's great. But there are a lot of people who were selling in 2022 and 2023 where the market was bottoming. That was not a good time to be selling. This was again because the market was forward looking. By the time the fear reached the retail investors, it was too late. This was actually one of the biggest crises that I averted. I was actually buying during those bad times and it paid off really well. Even if you missed out last time, do not worry. Try to learn from the mistakes and continue investing. When it comes to macro, you also have to consider the effects of war and whatnot, but make sure you do not act irrationally when it comes to these factors as well. I have a full video dedicated to what happens to markets during war times. Feel free to check it out. Another closely related mistake is because you are reacting to political changes or events. Simply put, you should not be relying too much on elections and political events for your investment decisions. The reality is that markets have historically grown regardless of political leaderships, and they will continue to do so. This one's also a very complicated topic because the markets might be affected a little bit based on who's in the House, who's the president, and who's in the Senate. I've actually covered this in a very recent video. You can check it out if you want to. Even if you don't check it out, the best advice I have gotten is to not react to political events at all, because over a long period of time they do not have any impact on our investments. This of course depends on the current political systems we have in place in the West and does not rely on any fundamental shifts that might come in place. And these fundamental shifts do not happen overnight, over a few weeks, over a few months, or even a few years. This can take a lot of time. You will have enough time to react when something is going wrong. Talking about reacting brings us to the last mistake that you might be making, and that is rebalancing your portfolio too frequently. There are a lot of people out there who try to shift around their investments too often. They often hear that they should not be over diversified, and they try to change their investments way too often. While it's true that you should not be over diversified or you should not be too concentrated, it doesn't mean that you should be taking decisions all the time. For me, what I do is I take decisions on a quarterly basis when it comes to rebalancing. It gives me enough time to see everything grow or not and then decide what I want to do with it. Trying to rebalance too frequently can actually lead to unnecessary trading and even have tax implications. The better approach is to let your winners run unless fundamentals change. Again, when it comes to investing, you have to have at least 5 or 10 year time horizon and not take impulsive decisions all the time. If you cannot handle any of this, please stick to the S&P 500 and try to invest regularly, and that should be a good portfolio. So there you have it. Those are some of the terrible reasons I wanted to cover in this video. Overall, our key takeaway is that we should focus on business fundamentals, ignore short-term noise, stick to our investment strategy, make decisions based on facts, not emotions, and consider the long-term implications rather than immediate gratification. Now you might be wondering, what are some good reasons to sell our stocks? For that, you'll have to wait for another video. For now, remember that the best investors make money by patiently waiting for their investments to grow and not by actively trading based on external influence or emotions. On that note, I'll see you next week in a new video. Till then, keep learning and stay on top of your finances. Until next time.